The long end of the Treasury yield curve is screaming, showing deep fractures as a massive wave of financing threatens to overwhelm the bond market. BlackRock's chief investment officer of fixed income, Rieder, recently sat down on CNBC to analyze why long-term yields have become so volatile. By the end of this video breakdown, you will understand how this supply shock is reshaping interest rates and why the Fed's communication playbook is broken. But the real mystery is whether the Treasury's latest quiet intervention is actually a desperate attempt to cap borrowing costs before the election. Let's hear Rieder on CNBC, and after that I'll give you my own reaction breakdown to what he said.
The state of the markets according to one of the world's top investors, BlackRock's Rieder. He's chief investment officer of fixed income and head of the global allocation team at BlackRock. He is with me once again. Welcome back.
Thanks, sir. Thanks for having me.
What a great time to have you, given what's been happening in the bond market, which at the long end feels like it's been screaming a little bit. What do you make of where yields were and what the Treasury did today?
Listen, I mean, there's been the back end of the yield curves felt a bit untethered recently. I mean, for a couple of reasons. Obviously, you had some elevated inflation. You know, there was some discussion about could Chairworships have done more. Listen, I think really what's pushed rates higher is you have an incredible amount of financing that's coming. And not only financing.
The AI paper.
The AI paper that is just going to keep coming.
Okay.
And that's pressured supply into the market. I think that is the big thing. Listen, what the Secretary did today, you know, I think after doing the intervention on the yen, it's pretty clear they have a Secretary of Treasury that's keeping an eye on long-end interest rates. I think markets have to pay attention to that. Is it a huge move? It's not a huge move. The yen intervention wasn't a huge move.
Yeah.
But clearly there is a disposition there about, gosh, we have our eye on these rates and don't want them to get out of control.
There's a difference between a huge move and a huge statement.
100%.
This was the latter.
100%. And, you know, there's optics. Markets look at optics. They look at, we could debate, did you just cap a level on the long end of the curve? I'm not sure that that's right. But I think there's more firepower at Treasury. I quite frankly think there's more firepower in terms of how you manage the yield curve sitting at the Federal Reserve. I think that is going to Jackson Hole. That's going to be interesting to see how they address that. But listen, I think the Secretary is investigating a lot of things and saying, you know, how do I keep rate at a reasonable level given all the supply that's got to come?
Well, I mean, you've got the election coming up, too, and the midterms. That has to be somewhere in the calculus, no matter how much they want to talk about that. So how much difference will this move actually make if it's more a statement than a big move? And for how long will it make any bit of difference at the long end? So
when you take the actual real duration impact, it's not that big relative to the amount of supply that's coming. But I think what it puts in people's minds, I saw the yen intervention, I saw this, it does put a cap. And when people, there's been a big trade. I mean, a lot of people have curve steepeners on, a lot of people have short the back end on, a lot of people have, by the way, long equities, short long bonds. Mm-hmm. And I think there was a statement there like, be careful in how large you put that trade on. And I think you saw today a bit of scramble. Gosh, I got to manage some of that risk. And I think that, it's important. Markets move on sentiment. They move on like trying to interpret where we're going. And I think the statement was significant.
When you talked about, maybe some of the reasons why we've backed up at the long end, you said, I think your words were, could Chairworships have done more? Mm-hmm. I'm assuming you're alluding to, in his communication strategy, his guidance, if you will. Yeah. Is there a price to pay in the bond market for the lack thereof of communication? Is that in part at play here,
Scott,
too?
You know what? I don't. Depends on how you handle that. There's been a lot of stories about disastrous performance. I actually don't agree with that at all. I actually think he laid out a pragmatic, we've got task forces to look at these things. There are some very complex issues. Are we restrictive on rate? We're clearly restrictive on housing. We're not restrictive. We're not going to hamper AI CapEx spend. Inflation is complex. What's driving inflation today? Service is driving inflation. We don't have any goods inflation to speak about. These are all complex issues that he's going to take some time. He's going to take a look at it. So I don't think there is one thing that I think the chair needs to do over the coming weeks, and maybe Jackson Hole, maybe at the next FOMC meeting. What are the metrics you're looking at? What is your reaction function going to be? If you saw this sort of data, and by the way, it doesn't have to just be core PCE. Mm-hmm. I actually think it's incredibly healthy. We're getting away from just one singular number which can be skewed like it's been recently, and look at the broad picture of inflation, but give us some data in terms of what are the metrics you're going to look at, and then the markets can, which I think is the right thing, the markets could price to that.
Okay, so you're saying he does need to do a little bit more than he's given you and other market participants and the markets in general to this point.
That doesn't mean we need more forward guidance. Mm-hmm. That doesn't mean the dot plot is an effective mechanism. In fact, you look at over time, a lot of the communication we've gotten over the last few years hasn't been effective or hasn't been right in terms of where the world is going. The dot plot, I quite frankly don't find terribly useful, but the markets tend to move to it, even though they move around in terms of what they're going to do. So this idea we need more forward guidance, I'm not a real believer in that. I just think we need to know the reaction function. I just think we need to know, what are you looking at? What is important to you today? Is it more inflation? Is it more employment? Are you looking at, by the way, there's a series of indicators in employment. Are you looking at demand, supply? Are you looking at a whole series of different indicators? To get some clarity on that, then markets can do their job in interpreting it and putting a price on that.
The core issue driving this bond market anxiety is an unprecedented mismatch between the supply of government debt and the market's capacity to absorb it. When the CNBC host opened the discussion by asking about the sudden spike in long-duration yields, Rieder pointed directly to a structural shift in how the US Treasury is funding its deficits. He described the back end of the yield curve, specifically the 10-year and 30-year Treasury bonds, as having become untethered. This is a heavy word coming from the manager of BlackRock, ticker symbol BLK, which oversees trillions of dollars in global assets. In my take, when the world's largest asset manager warns that the benchmark risk-free rate of the world is drifting off its anchors, the entire financial system has to sit up and pay attention. This untethering is not just a technical glitch, it represents a fundamental repricing of long-term economic risk. Rieder explained that this volatility is being fueled by two distinct pressures: persistent, elevated inflation, and a relentless wave of new debt issuance that he labeled as AI paper. The sheer scale of capital required to build out global artificial intelligence infrastructure is forcing technology giants and infrastructure providers to tap the credit markets at a historic clip hand. They draw heavily on the debt markets. This corporate demand competes directly for the same pool of institutional capital that normally absorbs government debt. Rieder's point is that we are witnessing a double whammy. The private sector is borrowing aggressively to fund the technological revolution, while the public sector is borrowing aggressively just to keep the lights on. Let's keep this as is. It's solid. This brings us to a critical inflection point in the conversation, where the CNBC host pushed Rieder on how the financial system can possibly digest this mountain of debt without sending yields into the stratosphere. Rieder's response was fascinating, pointing out that the traditional buyers of long-term treasuries are no longer showing up with the same blank checks. Historically, foreign central banks, domestic commercial banks, and the Federal Reserve were the price-insensitive backstops of the bond market. Today, the Fed is actively shrinking its balance sheet through quantitative tightening. Commercial banks are nursing unrealized losses on their existing bond portfolios, and foreign buyers are facing higher hedging costs. So, who is left to buy? The answer is the private investor, the asset manager, and the pension fund. But these players are price-sensitive. They do not buy out of duty, they buy for yield. And to entice them to hold long-term debt in an inflationary environment, the market has to offer a significantly higher term premium. My take on this shift is that it represents a fundamental loss of control for policymakers. For over a decade, we lived in an artificial environment where the cost of money was heavily suppressed. Now, the bond market is asserting its independence at the exact moment the federal government needs to issue trillions of dollars in new debt. Think about the math here. This extra yield, or term premium, is the compensation investors demand for the risk of holding long-term debt instead of rolling over short-term cash. When that premium spikes, it forces every other borrowing cost in the economy upward, from credit cards to commercial real estate loans. If the market demands even a single percentage point of extra term premium on 10-year debt, it adds hundreds of billions of dollars to the annual interest expense of the United States. This is a compounding trap. The higher yields go, the more the deficit expands, which requires more bond issuance, which in turn forces yields even higher to attract those price-sensitive buyers. If you want more breakdowns at this depth, like the video and subscribe to the channel, and let's keep going. The host seized on this compounding pressure, turning the spotlight directly onto the Federal Reserve. He asked Rieder if the Fed's current communication playbook is actually making this supply problem worse. Rieder did not hold back, arguing that the central bank's forward guidance has become increasingly disconnected from fiscal reality. The Fed keeps trying to manage the short end of the curve with promises of future rate cuts, but the long end of the curve is looking past the central bank's dot plots and focusing entirely on the supply shock. According to Rieder, the Fed is trying to guide a market that has already moved past them, creating a dangerous gap between monetary policy and market pricing. Where I land on this is that the Fed is essentially playing checkers, while the fiscal authorities are playing a completely different game. Jerome Powell stands at the podium and talks about inflation returning to 2%, but the bond market looks at a 6% budget deficit during an economic expansion and realizes those two realities cannot coexist. You cannot run an expansionary fiscal policy and a contractionary monetary policy indefinitely without something snapping. The Fed's forward guidance is no longer a stabilizing tool. It has transitioned into a source of market confusion because it ignores the structural supply of debt flooding the system. This disconnect set up the most critical question of the entire interview. The host asked Rieder how the Treasury can possibly keep this massive financing machine running without causing a total meltdown in long-term yields. This is where Rieder pointed to a highly specific, quiet intervention that has been keeping the system afloat behind the scenes. He explained that the Treasury Department, led by Janet Yellen, has made a deliberate strategic choice to shift its issuance away from long-term bonds and heavily into short-term Treasury bills. By flooding the short end of the market with bills, they are actively avoiding the need to issue massive amounts of 10-year and 30-year debt, which has temporarily kept long-term yields from screaming higher. But is this bill-heavy strategy actually a sustainable solution, or is it just a temporary band-aid designed to get through a highly sensitive political calendar? Rieder was diplomatic, but his warning was clear. He characterized this move as a short-term liquidity management tool rather than a structural fix. When you fund a long-term deficit with short-term bills, you are essentially running a massive adjustable-rate mortgage on the nation's balance sheet. You have to constantly roll over trillions of dollars in debt every few months. If rates stay higher for longer, that entire mountain of short-term debt constantly reprices at the top of the market, rapidly accelerating the interest expense crisis. My take is that this is a high-stakes shell game. The Treasury is terrified of what a 5% 10-year yield would do to the mortgage market, corporate refinancing, and consumer confidence. So, they hide the supply in the T-bill market, where money market funds can easily absorb it. But this is not a free lunch. It is like trying to pay off your credit card with another credit card, hoping your salary doubles before the promotional interest rate expires. By shortening the average maturity of the national debt, the government is essentially locking us into a cycle of constant refinancing at today's elevated rates. If inflation remains sticky, and the Fed can't cut rates as quickly as the market hopes, we are going to see a massive wave of short-term debt rolling over at 5% or higher. That is a brutal reality. It means a larger and larger share of the federal budget will be swallowed up by interest payments, leaving less capital for everything else and putting immense structural pressure on the global financial system. So, where does this cycle actually end? When the host pressed Rieder on the ultimate endgame, Rieder pointed to a fundamental truth that many market bulls are actively ignoring. The system cannot rely on accounting tricks or treasury maneuvers forever. Eventually, the market has to find real long-term buyers for this debt. And if foreign central banks are stepping back, and domestic banks are already stuffed to the gills with low-yielding legacy bonds, who is left? The answer is the private sector. But private investors aren't going to show up out of charity. They are going to demand a much higher yield to take on that duration risk, which means the natural direction for long-term rates is still biased upward. This is the real danger of the current setup. If private capital has to absorb this historic wave of debt, it will inevitably crowd out private investment, push corporate borrowing costs to painful levels, and ultimately force a structural slowdown in economic growth. Rieder's warning isn't just about bond tickers or abstract yields, it is about a structural shift in how capital is allocated globally. We are moving out of the era of cheap money and into an era where the government's borrowing needs dictate the price of capital for every single business and household. What this means for your portfolio is that the traditional stock and bond allocation model is facing its toughest test in decades. If bonds can no longer act as a reliable hedge because of supply-driven volatility, investors will have to look elsewhere for safety. The big question moving forward is how long this delicate balancing act can hold before the Treasury is forced to pivot back to long-term issuance. If yields spike again, the Fed may have no choice but to step in and buy bonds, effectively abandoning its inflation fight to save the fiscal system. That is the ultimate macro loop to watch as we head into the next fiscal year. I appreciate you staying with the detail on this one. Like the video, subscribe to the channel, and tell me in the comments where you think I've got it wrong. See you next time.